Balance sheets. They sound boring, right? But what if I told you that knowing how to read one could help you understand if a company is a goldmine or a financial disaster? In the next 4 minutes, I'll break it down so simply that even your grandma could explain it to you. A balance sheet is one of the 3 key financial statements that help you analyze a company, along with the income statement P&L and the cash flow statement. Think of it like a financial X-ray. It shows what a company owns, who financed it, and if it's financially healthy or about to collapse. A balance sheet is divided into 2 sides: assets, what the company owns, liabilities, and equity, who financed those assets. In other words, on one side, you have what the company has. On the other side, you have who paid for it, shareholders or debtors. Assets are things the company owns and uses to make money. These include cash, because businesses need money to survive; accounts receivable, money customers owe the company; inventory, products waiting to be sold; property, plant and equipment, PPE, factories, offices, and machines; intangible assets, things like software, patents, and brand value. Assets equals stuff that brings money in, hopefully. On the other side, we have liabilities and equity, which answer the question, where did the money come from? Liabilities: debt, money the company owes to others; bank loans, money borrowed from banks; accounts payable, money owed to suppliers; other debts, taxes, bonds, leases, etc. Then we have equity, money that came from shareholders. Equity, owner's money. The company's net worth, capital invested by shareholders' retained earnings, profits from previous years that weren't distributed. So, in simple terms, liabilities equals money borrowed, equity equals money invested. Alone, a balance sheet doesn't tell the full story. That's why you need to look at it together with the P&L and cash flow statement. But there are still some big insights you can get just from the balance sheet alone. For example, you can calculate something super important: working capital. Working capital equals receivables plus inventory minus payables. Translation: it tells you if a business has enough short-term money to keep running. If working capital is negative, it means the company is using other people's money to fund itself. Take Amazon. They collect money from customers immediately, but pay suppliers 60 to 90 days later. That means they can use customer cash to fund operations, giving them more liquidity to grow fast. On the other hand, if a business has to pay suppliers immediately but gets paid by customers only after 60 days, well, that business might struggle with cash flow. So what did we learn today? A balance sheet shows what a company owns, assets, how it paid for those assets, liabilities, and equity. If it has short-term financial health, working capital. Understanding a balance sheet means you can spot strong businesses and avoid financial disasters. If you found this useful, hit like and subscribe for more quick business breakdowns.